72 pips. That was the intraday range on Aussie today. 72 pips straight up. And right now, at 0.72315, the entire market is asking one question. Is this the real breakout or the most convincing bull trap of the month? Most traders will chase this move. We are going to do the exact opposite. We are going to wait for the confirmation level that separates professionals from amateurs. And in the next 12 minutes, I'm giving you 3 exact trade setups with specific prices, including a conservative play, a standard retest entry, and a high-risk reversal if this thing collapses. Stick with me. What is going on, alpha traders? This is your host at the Meridian, where we turn volatility into profit and we trade what we see, not what we feel. Today is May 7th, 2026, and we are starting with AUDUSD because this pair just delivered a plus 0.69% rally that caught most of the market leaning the wrong way. The low was 0.71763. The high, 0.72772, and we closed near the highs at 0.72315. Here is my conclusion straight up. Trend is bullish on the 4-hour and daily, but we are now sitting directly inside a supply zone that has rejected price 3 times since late April. The multi-week trend is up. The moving averages tell us that. But the intraday risk of a fakeout above 0.7280 is very real. The multi-week trend is bullish above 0.7190. The immediate session is a wait and see until we clear 0.7280 or reject it. I will give you the exact price that turns me from bullish to bearish. Let's get into the structure. Pull up your charts. On the daily time frame, which is your truth teller, AUDUSD has been in a beautiful uptrend since mid-March. Look at the moving averages. MA5 is at 0.72391. MA10 at 0.72047. MA20 at 0.71969. MA40 at 0.71780. That's a fully stacked bullish alignment, shortest above longest, all sloping upward. That is institutional money flowing in, not retail noise. But here is the nuance that most YouTube analysts will miss. The daily candle today is a long upper wick. We opened at 0.71806, rallied hard to 0.72772, and then pulled back 20 pips into the close. That tells me sellers are stepping in exactly at that 0.7270 to 0.7280 zone. Go to your 4-hour chart. You will see 3 distinct rejections at 0.7275 since April 28th. This is not random. This is supply. And until we see a 4-hour candle close above 0.7285, I am treating this as a range top, not a breakout. Now zoom into the 60-minute chart. This is where the execution happens. Price is currently holding above the 60-minute MA20, which sits at roughly 0.7220. That's your immediate dynamic support. Below that, the 60-minute MA60 is at 0.7195. So the structure is clear. We have a rising floor and a hard ceiling. Let's talk about MACD because this is where the warning lies. On the daily chart, the MACD histogram is still positive, which is bullish. But the fast line is flattening. On the 4-hour chart, MACD is now curling down from an overextended level. No divergence yet, but the momentum is slowing. That means chasing the high here is statistically low probability. Key levels, write these down. Immediate support is at 0.7220, then 0.7195. Immediate resistance is at 0.7277, then the major weekly level at 0.7300 even. A daily close above 0.7300? That opens the door to 0.7400. A rejection below 0.7195? We retest 0.7100 now. Why did Aussie rally today? Let me connect the macro dots because you cannot trade this pair in isolation. First, broad US dollar weakness. The dollar index fell for the 3rd consecutive session. No major US data today, but the market is pre-positioning for a softer CPI print next week. That flows directly into AUDUSD as a dollar short play. Second, and more important for Australia specifically, Iron ore prices held above $118 per tonne overnight. Iron ore is Australia's largest export. When iron ore is strong, the Australian dollar tends to follow. And we also saw gold, which I will cover separately in this series, rally to test $2,350. Gold is a commodity proxy for the Aussie, and that correlation remains intact. Third, there is an RBA repricing happening quietly. The market had priced in a 25% chance of a rate cut by August. That probability has now dropped to 12% after stronger than expected retail sales data out of Australia 2 days ago. So the fundamental gap between the RBA, on hold, and the Fed, hoping to cut, is widening. That favours the Aussie, but here is the risk that nobody is talking about. Commodity Trading Advisor or CTA funds are now net long AUDUSD at the 75th percentile of their 1-year range. That means the smart money is already positioned for upside. When everyone is leaning the same way, a small negative surprise, say, weaker Chinese PMI or a sudden dollar bid, triggers a cascade of stops. That is why I am not chasing this move. I want a retest or a confirmed breakout. The 1 to 2 week view. Bullish above 0.7190. Targeting 0.7350. The risk event that could flip this? A hawkish Fed speaker or a spike in US bond yields above 4.65% on the 10-year now. Let's turn this analysis into money. I am giving you 3 distinct trades on AUDUSD. Each has a different risk profile. You pick the one that fits your sleep at night level. Strategy 1, conservative, high probability, small size. This is for traders who want confirmation before committing capital. We are not anticipating. We are reacting. Entry condition. Wait for price to pull back to the 4-hour MA20, currently at 0.7205, and form a bullish reversal candle. That means a hammer or a bullish engulfing on the 60-minute chart. Alternatively, you can enter on a daily close above 0.7285 with volume stop loss. For the pullback entry, place your stop at 0.7180, which is just below the daily MA40 and today's low. That is a 25 pip risk. For the breakout entry, stop at 0.7260, take profit 1, 0.7275, scalp, take profit 2, 0.7330, 2.5 to 1 reward to risk on the pullback entry, invalidation. If price breaks and holds below 0.7180, this trade is dead. Do not add. Do not average down. Strategy 2, standard, retest of broken structure. This is my personal preference. We had a breakout above 0.7200 earlier today. I want to see that level act as support. Entry condition. Let price come back to the 0.7195 to 0.7210 zone on the 60-minute chart. Wait for a clear rejection wick or a bullish inside bar. Enter as price reclaims the 0.7210 level stop loss, 0.7175, just below the daily MA40 and the psychological 0.7180 level. Risk, 35 pips, take profit 1, 0.7270, 1.7 to 1, take profit 2, 0.7320, 3 to 1, management rule. Once price hits TP1, move your stop to break even. Let the second half run. Strategy 3, aggressive, fade the move, high risk. This is for professional risk takers only. If you have a small account or you are new to forex, skip this entirely. Scenario, price rallies to 0.7280 to 0.7290 but fails to close above 0.7285 on the 60-minute chart, and we see bearish divergence on the 4-hour MACD, meaning price makes a higher high but MACD makes a lower high entry. Short at market when the 60-minute candle closes below 0.7265 as a rejection signal stop loss, tight at 0.7305, only 40 pips above entry, take profit 1, 0.7220 take profit 2, 0.7195 warning, this is a counter. Trend trade. If the daily closes above 0.7300, cover immediately and flip long. This trade works only if sellers defend the range top. Again, I will be taking strategy 2 personally. But your risk tolerance is yours alone. Before I let you go, a mandatory risk check. On any Single orders trade. Do not risk more than 1% of your account. 1%. That means if you have a $10,000 account, your stop loss should not lose you more than $100. Position size accordingly. And never, I mean never, hold a orders position into major news unless you have a clear hedge. The next high-impact event is USDJPY on May 15th. Between now and then, we are in a news lull, which means technicals will rule. Now I want to hear from you. Scroll down to the comments and type your orders bias in one word. Bull, bear, or wait. And tell me your key level. Mine is 0.7285. What's yours? That comment section is our daily trading journal. Use it. Let me wrap today's orders analysis into 2 sentences. Long-term trend is up. Short-term is stretched and facing supply at 0.7280. Do not chase. Wait for a retest to 0.7200 or a confirmed breakout above 0.7285. Those are the only 2 scenarios I trade. Tomorrow, we are covering USDJPY and Nikkei 225 as a link pair because the yen is about to hit intervention territory again. The 160 level on USDJPY is a line in the sand for the Bank of Japan, and the Nikkei's reaction will tell us whether risk appetite is real or fake. Do not miss that episode that if this analysis added at least 1 pip to your edge today, hit the like button. Subscribe with notifications on so you get every video the moment it drops. This is the Meridian. Stay disciplined. Stay data-driven. And I will see you on the next candle.